Never time the market is financially reckless advice for most of your goals. Saving for a house? The average down payment just hit over $63,000. But the 2024 Dalbar study proved the average investor sabotages their own returns by trying to time things. Here's the system to avoid that, built for today's economy. This isn't just about saving more money. It's about making the money you already save work smarter and safer, especially when you have a big goal like buying a home that's just a few years away. We're going to build a clear, data-driven framework today that removes the guesswork and the anxiety from your financial life. Let's get started. To understand the solution, we first need to diagnose the two hidden problems every saver faces. These are the twin fears that paralyze people, forcing them into one of two traps: either taking on way too much risk or taking on way too little. Both can be devastating for a 5-year goal, and today we're going to build a system that navigates right between them. The first problem is what the financial world calls the behavior gap. This is one of the most important concepts you can ever learn about investing, because it proves that success isn't about being the smartest person in the room. It's about having the best discipline. The prestigious Dalbar 2024 Quantitative Analysis of Investor Behavior is a study that has been tracking this for decades, and its findings are consistently shocking. It looks at how the actual stock market performed versus how the average person investing in that market performed. What it finds is a huge gap. For instance, looking at historical data provided by Slick Charts, the S&P 500 index has returned about 11.2% on average annually over the long term. But the Dalbar study found the average equity investor only captured about 8.7% of that return. That 2.5% difference every single year is the behavior gap. It's the price people pay for emotional decisions. It's the cost of panicking when the market drops and selling at the bottom, and then getting greedy when the market is high and buying at the top. This isn't an intelligence problem. It's a human, emotional one. Our instincts, which are great for keeping us safe from physical threats, are terrible for investing. This gap is proof that without a system, our emotions become our own worst financial enemy. Now, knowing this, you might think the answer is to just put your money in the market and never touch it. That works for long-term goals like retirement. But it introduces the second major problem for a 5-year goal: the risk of being too aggressive. Let's make this concrete. Imagine you need $64,000 for a down payment in 5 years. You've been diligently investing, and by the end of year 4, you've successfully grown your account to $60,000. You're almost there. But then a recession hits, or a global event causes a market panic. The stock market drops 20% in a few months. This isn't a rare black swan event. Market corrections of 10 to 20% are a normal part of the economic cycle. Suddenly, your $60,000 is now worth only $48,000. You've lost $12,000 right before you needed to use the money. You don't have another 5 or 10 years for the market to recover. You need that money next year. Your dream of buying a house is now delayed, potentially for years, all because your timeline was too short for the risk you were taking. A 20% drop in year 4 is absolutely devastating, and it's a risk that standard "just invest in the S&P 500" advice completely ignores when it comes to medium-term goals. So if being too aggressive is dangerous, the logical answer seems to be to play it safe, right? Just keep all your money in cash in a checking or savings account. This leads us to the third and perhaps most insidious problem: the risk of being too conservative. Cash feels safe, but it's silently losing value every single day. This enemy is called inflation. According to the U.S. Bureau of Labor Statistics, as of their latest data from October 2024, the annual inflation rate is 3.1%. What this means is that a basket of goods and services that cost you $100 last year now costs you $103.10 this year. Your money needs to earn more than 3.1% interest just to maintain its purchasing power. Just to stand still. If your money is sitting in a standard checking account earning 0%, or a traditional savings account earning maybe 0.1%, you are guaranteed to be losing money. Every year, your savings can buy less and less. That safe cash is on a slow-motion treadmill to worthlessness. The feeling that your savings account is actually a losing account is not just a feeling. It's a mathematical reality in the current environment. Let's stop talking about abstract percentages and make this real. Meet Alex. Alex is 30 years old, works as a graphic designer, and earns a solid salary of $75,000 a year. He's a disciplined saver, putting away $950 every single month. His big goal is to buy a house in about 5 years, and he's already saved up an impressive $10,000. But that $10,000 is just sitting in his standard checking account, earning absolutely nothing. Alex is paralyzed by those two fears we just talked about. Fear number one is the market. He hears stories about people losing everything in a crash, and the thought of his hard-earned $10,000 down payment disappearing overnight is terrifying. Fear number two is that he feels like he's falling behind. He's smart enough to know about inflation. He can do the math. With inflation at 3.1%, his $10,000 is losing $310 in purchasing power this year alone. It's effectively becoming $9,690 in terms of what it can actually buy. He feels stuck between a rock and a hard place. He knows just invest is too risky for his timeline, and just save is a guaranteed loss. So he does nothing. This inaction feels safe, but it's actively working against his goal. The first step for Alex is a mental one. He needs to acknowledge that both of his fears are completely valid. They aren't irrational. The market is risky on a short timeline, and inflation is eroding his cash. The solution isn't to pick one fear to ignore. It's to find a system that addresses both. He needs to realize that just invest and just save are both incomplete and therefore incorrect answers. The real solution is to separate his money based on its timeline and its purpose. Once he grasps this, Alex stops feeling stuck. He's no longer looking for a single magic bullet account to solve all his problems. Instead, he's ready to learn a framework that can manage both risks simultaneously, giving each dollar a specific job to do. Comment inflation below if you've ever felt your savings account was actually a losing account. So how do we fix this? With a simple but powerful system I call the 3 money baskets. This framework is designed to give every dollar you save a clear purpose and timeline, which in turn tells you exactly where that dollar should be stored. It replaces fear and guessing with logic and automation. Let's build it, one basket at a time. First up is basket number 1, which holds your money for the 0 to 1 year horizon. This is your emergency fund. The sole purpose of this basket is not growth. It is safety, stability, and immediate access. Think of this as your financial fire extinguisher. You don't buy a fire extinguisher hoping to make a profit on it. You buy it for peace of mind, knowing it will be there, ready to work, the second you need it. This basket is for 3 to 6 months of your essential living expenses. This means rent or mortgage, utilities, food, transportation, and insurance. It's the money that lets you sleep at night, knowing that if you lose your job or face an unexpected medical bill, your financial life won't be completely derailed. Because the goal here is liquidity, you should never, ever invest your emergency fund in the stock market. You can't afford for it to be down 20% on the day your car breaks down. The ideal home for this money is a high-yield savings account, or HYSA. These accounts are FDIC insured up to $250,000, so they are incredibly safe. And unlike a traditional savings account, they actually pay a competitive interest rate that helps fight off inflation. This brings us to the second, and for our purposes today, the most important basket. Basket number 2 is for your 1 to 5 year horizon. This is your goal fund. This is where you save for that house down payment, a new car, a wedding, or any other major expense that is more than a year away but less than 5 or 7 years away. The priority for this basket is capital preservation while beating inflation. You need to know that the principal amount will be there when you need it, but you also can't let it get eaten away by the 3.1% inflation we discussed. This is where products like high-yield savings accounts and certificates of deposit, or CDs, absolutely shine. Right now, you're not settling for the 0.1% offered by big brick-and-mortar banks. According to financial rate aggregator Bankrate, as of December 2024, you can get rates as high as 4.20% APY in a high-yield savings account. This comfortably beats that 3.1% inflation, meaning your money is not just safe, it's actually growing in real purchasing power. This basket is the missing link for most people's financial plans. They either treat all their savings like an emergency fund, basket 1, and lose to inflation, or they treat it all like retirement money, basket 3, and take on far too much risk. And that leads us to our final basket. Basket number 3 is for your long-term growth, covering anything with a 5+ year horizon. For most people, this means retirement, which could be decades away. This is the only place where you should be taking on significant stock market risk. Why? Because time is your greatest ally. Over long periods, the market has historically gone up, but in any given year, it can be wildly unpredictable. With a multi-decade timeline, you have plenty of time to recover from the inevitable downturns and corrections. This is where you aim for higher growth, like the S&P 500's historical average annual return of around 11.2%, according to data from Slick Charts tracking the period from 1984 to 2024. But because it's volatile, you only put money here that you won't touch for at least 5 to 7 years, and ideally much longer. This basket is where you'll find your 401k, your Roth IRA, and other brokerage accounts invested in low-cost, diversified options, like an S&P 500 index fund. Most people mix up basket 2 and basket 3, and that's the mistake that costs them everything. They put their house down payment money into the stock market and pray it goes up in time. That's not investing. That's gambling. The 3-basket system prevents this by creating a firewall between your different goals. In a minute, I'll show you the exact calculation Alex can use to see if he's on track to hit his goal. Let's go back to Alex. He understands the framework, and now he's ready to take action with his $10,000 lump sum and his $950 monthly savings. He was stuck, But now he has a clear plan. Here are the exact steps he takes. First, for basket 1, his emergency fund, he calculates that his essential monthly expenses are about $3,000. He wants a 5-month emergency fund, so his target is $15,000. He starts by opening a high-yield savings account from a provider like Peak Bank, which bank rate cites as offering a 4.20% APY. He immediately moves his existing $10,000 from his checking account into this new HYSA. It's now safe, liquid, and finally earning a real return. Next, for basket 2, his down payment fund, he opens a second, separate HYSA. He wants to keep it distinct from his emergency fund, so he's not tempted to dip into it. He sets up an automated transfer from his checking account to this new HYSA for $950, scheduled for the day after he gets paid. He considered a certificate of deposit, or CD, which sometimes offers slightly higher rates, but he chose the HYSA for more flexibility in case his plans change. Finally, for basket 3, his long-term growth, Alex doesn't need to do anything new just yet. He already has a 401k through his employer. He logs in, checks his investments, and confirms that his contributions are going into a low-cost S&P 500 index fund. The key here is the mental shift. He now sees this 401k as completely separate from his 5-year house goal. It's for Alex in his 60s, not for Alex in his 30s. With this automated, logical system in place, Alex can finally feel in control. The anxiety is gone, replaced by confidence, and now he can do the math to see if his plan will actually work. Let's run the numbers. He's saving $950 every month in his basket 2 HYSA. To be conservative, let's assume an average APY of 4.15% over the next 5 years. We can use a future value calculation to see what that grows to. Over 60 months, his consistent contributions, combined with the power of compounding interest, will grow to over $63,000. Let's be precise. It will be $63,156. This puts him right on track for his goal of a nearly $64,000 down payment. He's going to achieve this without taking on the inappropriate risk of the stock market for his medium-term goal. His emergency fund is protected, his down payment is steadily growing above inflation, and his retirement is invested for the long haul. He's no longer choosing between being too scared or too reckless. He's doing both, safely and systematically. Okay, you've built the safe system. You've separated your money, you're beating inflation, and you're protecting your short-term goals. This is the essential foundation. Now, let's talk about the advanced move that turns market fear into your financial advantage. This brings us back to the controversial idea from the beginning of the video: timing the market. What I'm about to show you is not about traditional market timing, which is a loser's game. Trying to predict whether the market will go up or down tomorrow is impossible. What we're talking about is having a predefined set of rules for strategic rebalancing. The difference is profound. Prediction is about guessing. A rules-based system is about reacting in a logical, predetermined way. You make the decision once, when you are calm and rational, so that you can simply execute the plan when everyone else is panicking. This is how you close that behavior gap we talked about earlier and turn it in your favor. So, what does this rule look like? It's actually very simple, and you define it for yourself ahead of time. The rule is this: when the stock market, your basket 3, drops by a significant predetermined amount, you will move a small predetermined amount of excess cash from your Goal Fund Basket 2 to your Long-Term Growth Fund Basket 3. Let's break that down. First, the trigger. You need to define what a significant drop means to you. A common and historically relevant trigger is a 20% drop in the S&P 500 from its recent high. This signals that the market is officially in a bear market. Second, the amount. This is crucial. You are not moving your entire down payment fund. You are only moving a small, predetermined amount of excess cash. This could be a fixed amount, like $5,000, or a percentage of your Basket 2 funds. This is money that is above what you absolutely need to stay on track for your primary goal. By setting these rules in stone now, you create an unemotional instruction manual for your future self. When the news is screaming recession and your gut is telling you to sell everything, your instruction manual simply says, the market is down 20%. Execute transfer of $5,000. It turns a moment of fear into an opportunity to buy quality assets when they are on sale. To really understand the power of this, let's visualize it with what I call the chart. Imagine we are tracking a $10,000 sum over 3 years. Let's look at two different paths for this money. Path 1 is the perfectly safe path. The $10,000 is placed in a high-yield savings account, earning a steady 4.15% APY. After 3 years, it grows predictably and safely to about $11,298. There's no stress, no volatility, just slow and steady growth. Now let's look at Path 2, the strategic rebalancing path. The $10,000 starts in the same HYSA. For the first year, it behaves exactly like Path 1, but then a market crash happens, and the S&P 500 drops 20%. At this moment, following our predefined rule, we move the $10,000 from the safety of the HYSA into a low-cost S&P 500 index fund. We are essentially buying stocks at a 20% discount. For the next 2 years, the market recovers, which it has done after every single previous downturn in history. Because we bought in at that low point, our $10,000 experiences supercharged growth during the recovery. By the end of the same 3-year period, that $10,000 in Path 2 could be worth $14,000, $15,000, or even more, depending on the speed of the recovery. It ends up significantly higher than the safe path. This illustrates the opportunity cost of being purely defensive. By having a rule, we were able to deploy cash strategically to capture an incredible growth opportunity that fear would have made us miss. Let's bring this home with Alex one last time. It's now 3 years into his 5-year plan. He's been incredibly disciplined. His emergency fund in Basket 1 is full. His down payment fund in Basket 2 has grown steadily and now has over $37,000 in it, putting him slightly ahead of schedule. Then it happens. A global crisis triggers a market panic, and the S&P 500 crashes, dropping 25% in a matter of weeks. The news is a constant barrage of negativity, screaming about recession and financial collapse. Emotionally, Alex feels the panic. His instinct is to sell everything, hide his money under the mattress, and wait for the storm to pass. But his system gives him a different, clearer, and unemotional instruction. He pulls up the simple rule he wrote for himself 3 years ago. It says, if the S&P 500 drops by 20% or more, move $5,000 from Basket 2 to Basket 3. He checks his Basket 2. He needs about $35,000 at this point to be on track, and he has $37,000. He has a $2,000 buffer. He can afford to move the $5,000 without jeopardizing his primary goal. So he takes a deep breath, ignores the headlines, and follows his plan. He logs into his accounts and moves exactly $5,000 from his HYSA into his Roth IRA, which holds his S&P 500 index fund. He did not touch the core $32,000 he needs to stay on track for his down payment. The risk is completely contained to his extra savings. In that moment, Alex transformed from a passive saver into a strategic investor. He took advantage of the market sale without jeopardizing his primary goal. That one disciplined move of buying $5,000 of assets at a 25% discount will dramatically accelerate his long-term growth in Basket 3 for decades to come. He feels empowered instead of fearful, all because he had a system. Let's recap what we've learned. The old advice is broken because it doesn't account for your emotions or your specific timelines. The new way is systematic. First, and most importantly, your emotions are your biggest enemy in finance. The Dalbar study proves this year after year. A system will always beat raw instinct over the long term. Second, the core of that system is to separate your money by its time horizon into 3 distinct baskets. Basket 1 for your emergency fund with a 0 to 1 year timeline, kept in cash. Basket 2 for your medium-term goals with a 1 to 5 year timeline, kept in safe, inflation-beating accounts like HISAs. And Basket 3 for your long-term growth with a 5+ year timeline, which is the only place for stock market risk. Finally, you don't time the market by guessing. You create rules for strategic rebalancing to allow you to buy great assets when they go on sale without risking the money you need for your core goals. This isn't just theory. It's an actionable plan you can start today. Here are your next steps. Your immediate action for today is to calculate 3 months of your essential living expenses. Just get the number. That is your Basket 1 target. It makes the goal real. Your short-term action for this week is to go online and open a high-yield savings account. Go to a site like Bankrate, look at the top rates, and pick one. It takes 10 minutes, and it will be the most profitable 10 minutes of your year. Finally, your long-term action. Open a notebook or a document and write down your rebalancing rule. It can be simple. If the S&P 500 drops 20%, I will move $2,000 from Basket 2 to Basket 3. Make the decision now while you're calm and rational. Your future self will thank you for it. If this framework was helpful, hit the like button so I know to make more content like this, and subscribe for more data-driven strategies to build wealth. And finally, share this with one friend who is saving for a big goal and is feeling stuck, just like Alex was. You might give them the clarity they need to finally get started. This is for educational purposes only and is not financial advice. All investment strategies involve risk. The numbers and rates discussed are based on data from December 2024 and are subject to change.